Welcome to today's SL Live webinar on unlocking R&D tax credits. I'm Mike Mondelli, a director in SingerLewak Tax Advisory Group, and joining me is Lydia Clowney, a director and the leader of SingerLewak's R&D Tax Credits practice. We're both broadcasting from the chilly upper Midwest today. I'm in Minnesota and Lydia's in Michigan. Lydia, is it cold and snowy there?
Yeah, you can see it's whiteout conditions where I am.
I'm definitely looking forward to spring, although here in Minnesota, it's tough to believe that it's coming when you're in the middle of this cold part of the season.
I've always thought it might be harder to do tax season at a place where you actually wanted to be outside. So maybe it's kind of a blessing in disguise.
You might be right. I guess if you live in Arizona where it's so hot in the summer, you'd really want to enjoy March and April. But if you're a tax preparer, a CPA, you're stuck indoors during busy season at that time. So you're probably right.
Yeah, good time to hole up with the computer and the IRC.
Right. All right, today's topic is R&D tax credit. We're going to talk about some qualifying activities, different benefits, and a few common misconceptions about the credit. So why don't we just start right at the top? What are R&D tax credits, or how do you define what the federal R&D tax credit is for CPAs and others who may not work with it every day?
Well, and that's a great point. Which research credit are we talking about? And really mostly today we're going to be talking about the United States Federal Credit for Increasing Research Activities, which is the technical name or the name in the Internal Revenue Code for what we call the R&D tax credit. And it is an incentive offered by our government to incentivize companies to perform research and experimental or research and developmental activities within the United States. It was first put into the tax code in the 1980s, and it's been renewed a number of times since. At this point, it is a permanent piece of the tax code, so permanent until it is repealed.
That's right. Just like everything else in tax, it's permanent this year, but who knows what will happen in the future. And so this has been around for 45 years or so. I suppose the original intent behind this was to incentivize some research and development investment in domestic activities and production in the U.S.
Yeah, exactly. This is considered a boots on ground credit. So definitely the activities and expenses have to be incurred within the United States in order to qualify, which again was kind of Congress's intent, is to get more investment, more dollars spent in this area. Instead of, in the 80s, there was some globalization and some of the activity going overseas. Congress wanted to try to keep more of it in the United States. And so, you can think that there are, a lot of countries offer some kind of research credit because a lot of countries want to do kind of the same thing. And there are some really big differences between the United States credit and some other countries' credits. The United States credit actually has a lower credit percentage than a lot of other countries offer. And you might think that means that it's less valuable. But actually, they're structured so differently that there's not a lot of comparison you can make there. For one thing, the United States credit doesn't require that the research or experimentation, the R&D being done, doesn't need to be new to the world or even new to the industry in order to qualify. It basically just needs to be new to you. And that's very different from a lot of other countries that require there to be major advances in the science or the knowledge within a certain field in order to qualify for a credit.
That's interesting. I suppose a lot of people who aren't familiar with the United States federal tax credit for R&D might think, well, I haven't invented anything new to the world, so I must not qualify for this. And that just doesn't sound like that's right.
We hear that a lot, and no, it's much broader than that. You can be working with a new technology, trying to develop a new process that's been perfectly proved out by the shop down the street. But if it's new to you and you have to experiment in order to figure out the solution, there might still be qualified activity there.
And we're going to focus on the federal tax credit today, but I know a lot of states also offer tax credits. Do you want to maybe say a little bit about that, how they differ, or what, what's going on with state R&D credits?
Sure. I think, it changes. I think we're up to 39 states at this point offering an R&D credit of some kind. And they really are very different from jurisdiction to jurisdiction. A lot of them mimic the federal credit calculation methods and rules, and others really kind of go off on a different angle. So some of them require an application. Some states have a total credit cap that gets allocated out to various claimants. Some base the credit on the federal qualified expenses. A lot more require that the expenses be located within the state in order to qualify for a state credit. And we see wildly different credit percentages from state to state as well.
That makes sense that you would have to probably be doing the activities in the state to qualify for a state credit. I guess one more question about state credits. Do you have to take the federal R&D tax credit in order to qualify for a state credit, or I suppose does that vary state by state?
It depends on the state. Some states require you to, like New Jersey. Other states do not.
Okay. All right, let's go on to who can qualify for an R&D credit. And you kind of already alluded to this a little bit in that you don't have to be inventing something brand new to the world, but in general, who can qualify for an R&D credit?
There really aren't any restrictions on the type of taxpayer you have to be or the type of industry you have to be in. Any U.S. taxpayer can qualify for a federal R&D credit if they are incurring qualified research expenses within the United States. So, the industries that we tend to see a lot of are going to be things like manufacturing, software development, and technology. We do see architecture, certain kinds of construction and engineering activities and entities. Certainly things like biotech and pharmaceuticals. But really, any company, you don't have to be a company that performs research and development as its core purpose in order to qualify. We see entities like a service organization, like a law firm, maybe developing a proprietary software can qualify.
I'm sure that would surprise a lot of people because they would think, if I'm doing R&D, I'm probably in the manufacturing space and building something or making some sort of product. But yeah, that's a good example of something that's totally service-based that can qualify. Are there other types of more surprising businesses or industries that qualify for the R&D credit that people would say, oh, I never would have thought of that?
One really interesting one for me was working with a greenhouse. They were, growing plants to sell to consumers. They also did some plant genomics, and we found qualified activities in a much wider range of what they did than just sort of this sciencey genomics area. They also had qualified activities in the process of how they grew plants in order to do that better, more disease resistant, experimenting with different ways of different soil, maybe different soil additives, different ways of turning lights on and off in order to, produce what they were growing.
Yeah, that one is surprising. I wouldn't have thought of that. So I'm glad I asked because that's very interesting. Are there any differences, if you're in a different type of entity, an S corp versus a C corp or a partnership or any business size limitations that affect the eligibility for this? Or can, most businesses qualify regardless of entity type or size?
Yeah, any type of entity can qualify, and any size of entity can qualify. S Corp can pass through credits to its shareholders. A sole proprietor can take advantage of credits, as can a publicly traded C Corp. There's a deeper question there, which is, can any given taxpayer actually benefit from a credit that is claimed? And that's not always certain. So the federal credit is, it's a credit. So it's a dollar for dollar reduction in tax liability. And it is a non-refundable credit. And what that means is that you have to have tax liability to offset with it, or else you can't really use it. Other credits like the child tax credit are refundable,
Right.
which means that if you don't have enough tax liability to absorb the whole credit, the government will send you a check for the difference. With the R&D credit, if you don't have enough tax liability to use the whole credit, you don't lose it, but it becomes a credit carry forward to future tax periods to offset future tax. You don't get that money back as a check from the government.
So if you can't use your whole R&D credit in the year that you earn it or calculate it, so 2025 or 2026, for example, you would get to continue to carry it forward to the future years. And then if you did have tax that you owed in 2026, 2027, 2028, you may be able to use the credit to offset it in those future years.
Yeah, absolutely. So the federal credit does carry forward for 20 years before, if you're still carrying it forward after 20 years, you still haven't had income tax after 20. There might be other problems there, but
yeah, I'd wonder if your business is viable at that point.
Right. Even at that point, you don't lose it. It becomes an additional NOL, or net operating loss. So it becomes a little bit less valuable since it's more like a deduction than a credit, but you don't lose it. Now, that's for most companies. There is a provision to allow certain startups really to be able to use the credit against their payroll tax liabilities instead of their income tax liabilities. And this is a really neat provision. Actually, Congress has been talking for years about trying to expand the pool of taxpayers that can take advantage of this provision. At this point, a company needs to have under $5 million of income in any given year and can't have had income more than 5 years prior to the credit year that we're talking about. If those couple things are true, though, so they haven't had any kind of gross receipts, and that includes even $1 of interest, but no gross receipts more than 5 years prior, and they are under that $5 million gross receipts threshold, then you can elect to claim up to $500,000 of your credit towards the payroll tax obligations instead of income tax liability. So for startup companies that are,
they're not profitable yet, so they don't have taxable income really.
Yeah, but you're still paying tax. You're still maybe paying your employees, and you have Social Security and Medicare tax to pay on them. And so it's a way of being able to monetize the credit earlier, for those startup entities.
Let's talk about what activities are considered qualified for R&D. And I've heard a little bit about this 4-part test. Actually, I've heard a lot about it, but I'll say I've heard a little bit about it. Can you tell us about the 4-part test and what activities work for the R&D credit?
Yep, and the 4-part test is definitely the big one. It's not the only test for qualification, but it's certainly the top line. If we don't meet the 4-part test, we kind of can't go further. So activities do need to meet all 4 parts of the test in order to qualify. Although activities must pass all 4 parts of the test in order to qualify. So the first is permitted purpose. Taxpayer needs to be attempting to develop new or improve upon the quality, functionality, reliability, or performance of a business component. A business component is the IRS way of saying a product, a process, a software, a technique, an invention, or a formula that is either used by the taxpayer in its trade or business or held for sale, lease, or license to third parties, or
Okay.
is intended to be held for sale, lease, or license to third parties if it's successful.
Got it. Okay. So you said attempt to develop a new or improved function, or so you can, this can be something brand new that you're starting from scratch, or this could be something that you've already have been doing, but now you're really trying to improve it or change it in a meaningful way.
Yes. We've made it materially better. Yes, or we're attempting to make it materially better in terms, again, of its function, its performance, its reliability, or its quality.
Got it.
We also need to have technical uncertainty at the outset of our development, well, during our development, in any one of three areas. Our capability, meaning can we do it? Our methodology, meaning how are we going to do it? Or the appropriate design of the business component. So what is our product or process or software actually going to look like when it's all done? Any of those are uncertain, then we'll pass that test.
Okay. And is there any definition or meaning for the technical part of it, or what, how do we know that our uncertainty is uncertain enough for the IRS?
So we need to be uncertain as to some technical details of, again, capability, methodology, appropriate design. If we're thinking, we don't know if we can do it because Yellowstone might explode and we will all die, that's not really technical uncertainty. Now, if the uncertainty is we are not aware of whether our new software module can actually talk to and integrate with an existing other software module. And we don't know how to actually code a patch to make those two softwares, integrate appropriately. That's technical uncertainty.
Okay. I flip-flopped the slides here out of order, so I think, normally we talk about process of experimentation as the third step, but I flipped them here, so that'll be next after technological in nature. Well,
and this is probably good, right? Because, what is technical uncertainty? It does relate to the fact that the experimentation does need to be technological in nature, and the IRS defines that as that the activities need to be predicated on the hard sciences, physical, biological, or computer sciences, or the principles of engineering. So we are not talking about financial uncertainty here. We're not talking about legal uncertainty here. We're not talking about aesthetic uncertainty. It has to be really focused in on those kind of hard science, again, technological details. And we come back to those sciences that are specifically called out: physical, biological, computer sciences, or again, the principles of engineering.
Okay. All right, now let's go to the last step in the four-part process, the process of experimentation. It can't just be that we, invented something new and got it right on the first try. I wouldn't think. Maybe that would work for a brand new product. If we're improving something, what does the process look like, or how do we have to experiment?
Experimentation is key for qualifying for the research credit. And this really goes hand in hand with that uncertainty. In order to alleviate our technical uncertainty about our capability, methodology, appropriate design, we need to be experimenting in order to figure out what the solution might be. So these really do kind of dovetail. So substantially all of the activities, and that's defined as 80% or more of the activities related to a particular business component, again, product, process, software, technique, invention, formula, must constitute a process of experimentation. So how do we define that? It's any systematic methodology designed to evaluate one or hopefully more than one alternative. And I really think about experimentation, the sort of the crux of that is being, are we feeding the results of our testing or evaluation of what we're trying to build back into our design and development process? So, if I think about kind of a classic design development life cycle, I'd probably start with trying to come up with what are the design requirements of the, let's say, product that I'm trying to make. What do I need it to do? And then what are the design specifications that will allow me to get there? How should it actually be sort of mocked up? And maybe I'm thinking about that first in my brain, trying to, list these out. Maybe then I move to, I'm sketching it out on a napkin. Maybe I take that and I put it into a computer software to model it out and see if the dimensions that I'm imagining will actually work within, virtual space. Okay, it works in virtual space. Do we need to test it out in physical space? Let's prototype that. Let's actually make a physical model. Does the physical model, respond and react the same way the virtual model did? Do we need to make any adjustments to our design between any of these stages? As we keep iterating and progressing the design and again, feeding the results of our testing back into the refinement of that design, that's like a classic process of experimentation.
It sounds a little bit like what we all learned maybe in science class in school, which was we have our hypothesis or our idea, then we design a test for it, then we test it, and then we check the results and see if it worked. And we probably go back to the beginning and come up with another idea and keep trying until we find something that works. Is that kind of how that's what we're talking about, right? It's like we don't have to have some fit it in the box of what the IRS says. These are the exact steps. This is how you have to do it. You're literally creating something that will change a product or a process, and you're doing it through the experimental process.
Yeah, exactly. And I would say that that's kind of the gold standard, right? I have an idea. Is it going to work? I got to test it to see. And then did it work? So that is that evaluative process that is considered to be a process of experimentation. And, you said, well, what if we get it right on the first try?
Yeah.
It happens sometimes, it does happen sometimes. And, getting it right on the first try is not a blocker to an activity being qualified. But maybe we'd want a little more documentation for that one, why, why it makes sense that even though for this one, we guessed right on the first try, that we still were going through that evaluative process and that it was an experimentation, even if, again, it was successful sooner than thought.
Yeah, that would be such a home run for the business anyway, that maybe the credit might be a secondary consideration. Because if you said, well, we got this exactly right and we can immediately put this into production, the time savings and the expense that you've saved by not having to go through a lot more process testing would be great. But it's probably rare that somebody really locks in on the first try and makes a new product or makes a process change totally successful. There probably are multiple iterations almost all the time, I would think.
Yeah, I think there usually are. And I would say that if something is straightforward enough that we do get it right on the first try, that can be an argument against there really being that technical uncertainty in the first place. And a lot of times we see this when we're talking about things like process improvements at maybe a manufacturer. A lot of times these manufacturing companies will have workers, maybe even in maintenance or facilities, who are so adept with the machines and so
Sure.
knowledgeable that even that making a change to a process, it's almost as though there's no uncertainty at all, just because they
Just
have
because they're
such an
highly
awareness of.
skilled.
Yeah. Yeah. And so, with situations like that, then we really want to try to kind of tease out, what kind of things were conceptualized maybe first. Perhaps there was an evaluative process that was happening before any kind of physical tests were made. Maybe there's a lot of that thought process going on, evaluating different alternatives, considering them, almost modeling them out in the computer that is the brain, and coming up with a solution that happens to be successful the first time. That could be a qualified activity. Again, it might be difficult to defend on an exam.
Right.
So yeah, a lot of these things, we get very sort of detailed about what's going on, how it's happening, and what are the considerations being made at that technical level. Again, sometimes almost just in someone's brain.
Let's talk about what expenses can qualify for the R&D credit. And I think there's probably a few main buckets here, beyond the wages that you pay to the employees that are performing the research. What kind of wages qualify, and then what are some of the other expenses that qualify for the credit?
The expenses that can qualify for the credit are very limited. And I get questions about this a lot, about why a certain expense that seems crucial to a development process can't be credit eligible for the federal research credit. And my answer is so unsatisfying, because my answer is, well, this is how Congress wrote the laws.
Yeah.
So you got the big one. A lot of the time, wages associated with qualified development by employees at a company are going to be the biggest, the largest expense. So for the wage piece of the credit, this needs to be wages that are taxable to an employee. So we look at usually box 1 W-2 wages, and we look at what proportion of each employee's time is spent on qualified R&D activities versus all other activities at work.
That makes sense.
Yeah, and figure out a kind of a ratio, and then apply that ratio against their taxable wages, against their compensation. So yeah, again, I'd say that's often the largest area. And
is that difficult in your experience for the businesses to break out or allocate wages for employees who do both R&D and non-R&D work?
I'd say some people find it very straightforward, and some people do struggle with it. I tend to think about, no shade at all, but some of us, and I'm guilty of this myself as a tax accountant, some of us want to be very precise and very detailed. And I think about kind of engineer brain. Sometimes it's like, if there isn't time tracking, or, I guess there are certain of us that are less comfortable making estimates.
Yeah, I suppose it really comes down to how detailed are the time tracking records, and some people are better at that in certain businesses than others.
And some people don't have time tracking records at all. There are plenty of entities, especially the smaller ones, where it's simply not a good use of time to be spending tracking things like that. And in fact, there's no requirement for an entity to have time tracking records at all to claim a credit or support it on exam. The use of estimates to come up with these numbers is absolutely appropriate. It's been tested through the tax code for decades, both in general in other areas, but very specifically for the R&D credit. So we tend to talk through a lot about what various people are doing with their day spent at work, and how that makes sense based on their general role at the company, and coming up with an estimate, even if it's something like, I think 50-50, half and half is the best idea that I have because of justification. That's a perfectly appropriate way of coming up with a wage inclusion. Now, obviously, depending on the activities the company is doing, what actually is the research, what are the employees' job titles and roles within the company, what is their technical background, all of these things, depending on the answers to those questions, we would likely recommend more or less documentation to support an inclusion. And, I think of something like, okay, well, we have some guy in maintenance, Dave in maintenance, and he's really highly qualified. We're saying he's 70% qualified in R&D at this widget making producer.
Yeah.
And that seems odd. Maintenance people aren't usually doing experimentation and development all of their time. Usually they're fixing machines, right? So that would be one to me where I'd say, let's get a little deeper here. Tell me more about this person.
We really need to know what Dave's doing, right? We need to know
what
he's doing.
What is Dave doing? Yeah, why is Dave working so much on experiment? Why isn't he working on maintenance? Okay, and so then I might be told, well, Dave's been here for 40 years. He's the only one who understands these machines, and he's the one, he actually, he does a little bit of maintenance, but mostly what he does is make substantive improvements to the throughput of the manufacturing lines in this way, and this way. Okay, well, that suddenly makes a lot more sense to me. Okay,
totally.
And then I can say maybe there are some records of, the testing you've done on these lines where Dave took it from 100 widgets per hour. Now we're at 150 widgets per hour. And that's the kind of thing that's going to be very compelling if a credit's ever pulled for exam.
What other kinds of expenses beyond wages can qualify?
Oh, good question. Okay, so supplies is another big one. Not for every company. Obviously, this is going to be more for that widget manufacturer and less for the software developer. But supplies is defined as tangible personal property, not of a character subject to the allowance for depreciation, that's used or consumed in qualified development activities.
That one seems like a pretty technical definition there. So it's non-depreciable stuff that you're using in your qualified activities.
Yeah, so not the big machinery, not the equipment, not the computers. But let's say, again, for that widget manufacturer and trying to increase the throughput on manufacturing line B, and trying to put materials through that line, and let's say, hey, it's not really working. The changes that Dave made to the line are now we're getting defects coming off those widgets. Okay, so all of those materials going through being tested as Dave works on improving the throughput to that line, those are going to be an expense that might be considered for the credit.
Got it.
Other things, so I said, supply is probably not going to be something we're looking at for a software developer, but something that would be relevant to the software developer is something we call computer rents and leases, which is another kind of weird, what is computer rents and leases? You might think, oh, well, I know what a computer rent and lease is because my job doesn't own my laptop. They, that they rent that from
whoever. Yeah.
Yeah. And it doesn't mean the laptop I'm working on, actually. Computer, this is one of these areas where I say, let's remember that the credit rules were written in the 1980s. And bafflingly, that was, what did you say, 45 years ago?
Yes.
I hate you for saying that. But it's true, and computers are really different then. So the idea about computer rents and leases back when these rules were being written is the rent or the expense you would pay to Microsoft to use their
computing time basically in
the computer's the size
somewhere
of a
else
room.
because businesses didn't all have a computer on every desk in every office and every cubicle and every part of the companies like we do nowadays.
Right, it was pre-PC. So renting computing time from a think tank or something like that would be a qualified expense. So that was pretty rare. And there was, and here's a crucial rule for computer rents and leases. The computer cannot be owned by you or located on your premises.
Interesting. I wonder how that, I don't want to open a can of worms, but in today's cloud-based computing environment, a lot of what I do in my practice at an accounting firm, it takes place in the cloud and nothing's really stored locally. So it sounds like some of these rules may need a refresh or an update for today's technological world soon.
Yeah, and it's been tough to make these sort of incremental improvements to the tax code. So I don't know whether we can really expect that, but this is so interesting. And of course, yes, I have to talk about the cloud because, like I say, this rule wasn't written to really to cover the ways we use computers today. And there were years after PCs became a thing. We started using computers within our own, businesses and homes. And before cloud computing became a thing, where if you saw an expense on the computer rents and leases line on a Form 6765 in a tax return, you'd say, oh, someone did something wrong. Someone messed up here. Someone didn't understand what this was,
right?
Or they put their supplies on the wrong line. Something's fishy. And then all of a sudden, here we have this new world. Yes, we have the cloud and, AWS resources or Microsoft Azure. It's computing resources not owned by us or located on our premises. It really seems to fall very neatly into this definition, not in any way intentionally, but just by chance. So this is something that we are claiming at this point, that, again, cloud hosting expenses used for qualified software development activities is something that we're currently putting into credit calculations. Now, this is a really sort of new and untested area of the research credit. So we haven't seen a lot of regulation or court judgments about how the IRS will audit these or what their real feelings or kind of where the boundaries are for that. So I think this is a really interesting area to watch.
It is interesting because it does seem like that's doing the same type of stuff that was happening back in the 1980s. It's just doing it on a much different scale now, and how it's delivered to the end user, the business here, is different than how it was done back in the 1980s. But that is interesting. I guess we'll see what happens with that over the next few years as that gets tested in some IRS audits and probably some United States tax court cases.
Yeah.
Contract research, I think, is the last area that you wanted to cover here before we move on.
Yeah, so contract research, third-party contractors assisting with qualified development. Think about it. This would be activities that would qualify if our employees were doing them. But instead we're paying a third party to do them instead. So this could be something like a 1099 contractor who's working pretty similarly to an employee, or it could be, paying a third party company to do some kind of research. Again, maybe think about that law firm that we talked about. That with the proprietary software, maybe they're not developing it in-house. They don't have developers. They've contracted with a third party to develop it on their behalf. That expense paid to the contractor might be a qualified research expense. Now, there are additional rules and restrictions for contract research. So the contract research, in order to qualify, has to be incurred subject to an agreement. And this is kind of interesting. There does have to be some kind of agreement before the expense is incurred. The taxpayer has to maintain, the taxpayer who's trying to claim credit for the expense has to have rights and risks in the research per the contract. So what does that mean? Rights, we have to have substantial rights to the results of the research. So think about kind of the intellectual property being created by the research being conducted. Who has rights to it? Substantial. What are substantial rights? Substantial rights are rights that have substance. So we don't need exclusive rights to the IP to qualify, but we have to be able to exploit or use the research without any kind of additional payment or agreement to the contractor. So in the case of, say, the software, I'm paying someone else to do software development on my behalf. Do I have rights to that code? Can I get into the code and manipulate it, customize it, modify it, turn around and use it in another project of mine without having to have the agreement of the developer that made it, or paying them additional license fees? Okay. If that's the case, then yeah, I have substantial rights to that. We also need to have risk. And risk, substantial rights. Both parties to a contract can come out of the contract with substantial rights, but only one party to the contract is going to have the economic risk of the success or failure of the development. And this is important because the IRS, or really Congress, wants to make sure that only one taxpayer can take credit for the activities. And
so in this case, if we're the law firm hiring the third party to help us develop our proprietary software, if the law firm has the substantial risk and the rights, they would be the one to get the credit, and the developer could not also take a R&D credit on the exact same stuff that they were doing?
Right. The law firm and the software developer can't both take credit on the same project. So that makes sense. Maybe they both have substantial rights to the software being created, but who's at risk there? And so we look to the payment terms, usually the contract terms. So who will have to pay more if the project goes south, if things take longer than expected,
it goes over budget, who has to pay?
Not working. So yeah, a really simple way to think of it is if the law firm is paying the software developer time and materials to produce the software, then the law firm is absolutely at risk, because if the development's going badly and they need more hours of work on that project, and they figured out there's actually a problem with this one module and they're going to have to create a custom patch again, okay, we're going to charge you extra. Law firm's at risk. They have all of that economic risk. On the other hand, let's say law firm is contracted with a software developer. The software developer says, we'll make you that software and it'll cost you 50 grand, period. It's a flat fee. And software developers thinking that they can do it for less than that. Okay. All of the economic risk at that point is on software developer. If they bid that wrong, if things go south, if things start taking more time, let's say all their qualified developers, they're really great developers, all quit and they have to hire a bunch of newbies who don't know what they're doing and things are just slogging. Law firm's still only going to pay $50K. Law firm's not at risk. Law firm cannot take credit
No R&D credit for the law firm.
for that software. And so you can think you can get into a situation where nobody can take credit for the activity. Let's say law firm has 100% exclusive rights to the IP, but they're paying a fixed fee to software developer. Nobody gets the credit.
All right, let's talk about what I'm going to skip ahead several slides here because I was too engrossed in your explanations. Let's talk about what documentation is required for sort of claiming the R&D credit, calculating it. What do you need to have in your tax records after the fact to prove that you qualified for these credits?
So to compute a credit, usually what we are looking at is financial records. A lot of times that'll be general ledgers or sometimes trial balances, payroll records, project descriptions, sometimes interviews with technical personnel. If a company uses time tracking, that would be another document. And all those things going into kind of putting the credit calculation together, and certainly used to support on exam if the credit is pulled for exam. Now, right now we're in a little bit of a transition period with regard to the credit reporting requirements. Just in the last year or so, we have a new Form 6765. Form 6765 is how we report the federal credit for increasing research activities with a tax return. It used to be 2 pages, and it basically just included summary numbers for whichever credit method was chosen. So total qualified wages, total qualified supplies, total qualified contract research, et cetera, to come up with the numbers. We're now at, I want to say, 5-page, I can't remember, 4 or 5-page Form 6765. A lot of additional information, being requested. It's not yet mandatory to fill out the additional information, but we do expect that to come. We actually expected it for tax year 2025, and then it was delayed another year. So now we're expecting it for tax year 2026. But at that point, we're going to see many, if not most, taxpayers required to report their qualified research expenses on a business component level. So not just the total qualified wages, but the qualified wages associated with each qualified business component. So essentially breaking out all of the qualified expenses on a project by project basis, and sharing some additional information about the qualitative aspect of the project. So what is the project name? And what is it a product, process, software? What information is being sought to discover on this project? And then what are, how much qualified wages associated with this project versus project 2 versus project 3? How much supply? How much qualified computer rents and leases? So again, this is
sounds like
quite a lot more information. Yes,
yeah,
in some ways mimics the information requested like on the first information document request of an audit.
Yeah, that's what I was thinking. And I'm thinking ahead. Once this new 6765 is required for anyone claiming their credit, if you're going to try and get your tax return filed by the due date without extending, and you're going to be able to get all of this, broken out by all your qualified research expenditures and activities by the business component, that might be tough. I see a lot of extensions requested for businesses claiming the R&D credit in the future if they're not already doing it. That sounds like it would be a heavy lift to get in time for a March 15th or April 15th filing.
It's the kind of thing that some companies have it and some companies don't. So for the companies that have been filing credits and not collecting and documenting this information, taking more of a wait and see approach. Oh, I'll compile, I know my projects are qualified, but I'm just going to compile that information if I get pulled for exam.
Yeah.
Those companies are going to have a little bit of a harder lift. Once this kind of information starts to be tracked, it tends to get a little bit easier. But of course, this is going to be hugely different entity to entity because different companies have different project turnover. If you're working on 100 different projects in a year versus, we've been working on this one software project for 3 years now. That's going to be a kind of a really different thing. I will say
and I actually
there are
do a lot of work. Oh, go ahead.
Yeah, the rules for the reporting of business components, it's the IRS is not expecting folks to provide 1,000 projects on a submission. They're limited to the top 50 projects or projects which cover 80% of the qualified expenses, I believe. But still, 50 projects can still be quite a lot to understand and document and quantify.
Yeah, I was going to say I've done a lot of work representing clients in IRS examinations, and everyone is always highly unique. The facts and circumstances of what each individual business is doing are so personalized that while the IRS has some things that they're looking for in every examination that involves an R&D credit, like you get the information document request, it's pretty standardized, but there's not really any specific set of requirements. Like your documentation doesn't have to meet all these qualifications on a checklist or it's invalid. It really is personalized to the individual taxpayer, the individual business. Their records are not going to be the same as any other business's records, unless I suppose maybe if you're like a franchise owner or something like that, maybe your records are really standardized. But the documentation that you need to retain so that you could provide it in case of an IRS examination, to support your credit, it really is, it's very dependent on what documentation you actually created, what documentation actually exists in your business, right? It's not one size fits all where the IRS is coming in and saying, well, you didn't have these things that we saw in the last business that we audited, so therefore no credit for you. It just doesn't work that way, right?
No, you're absolutely right. There's no set documentation requirements, and you're right that every audit is different. We come into each one kind of almost a blank slate because the facts and circumstances will be different too. And so the areas that IRS is interested in poking the most are probably going to change too. Now, we definitely do see some broad trends. I know that in IRS exams for research credits I've seen in the last, 5 years or so have hit really heavily on the process of experimentation piece and wanting to show, the steps of that process.
Show your work.
And to try to provide contemporaneous documentation or documentation that was created at the time the research was being conducted, to show the steps and stages that the research went through and how the results of research were fed back into, refining the product or process or software. That's been something we've been hearing a lot on exams, but that wasn't always the case. 10 years before that, it was really more heavily weighted in different areas. So there are some broad trends. And then, we just try to think about what documentation exists at the company that can support the assertions that we're making through the credit. And actually, I think this is a kind of an interesting area because I talk a lot to financial personnel, and I kind of see this really scared look on their face. They say, I don't know how we'd support the process of experimentation for something like this, because that's simply not part of what they do with regard to these projects. They see the quantification, and they aren't collecting and viewing. They might not even know what kinds of documentation exist at the company that would support the qualification of an activity, because that's simply not what they deal with. And they don't know what engineering might have that, a lot of times we end up, I see, again, sort of fear and uncertainty about what exists to support until we get to the right people at the company, and they say, I've got folders and folders of this stuff. You want design revisions?
Exactly.
Yeah. You want a project list? I've got project lists going back, for each quarter, going back 10 years. And of course, that's not always the case, but it really does tend to be, we need to get to the right people in the right areas of the company to see kind of the depth of the information that does already exist. And for me, my job is to help companies through this process, and I'm never coming in telling people that they need to create a bunch of stuff new. I mean, I'm happy to help advise if you want to ask me questions about what might be helpful in the future, but really what we're trying to figure out is what already exists that can help us paint this picture and provide a convincing narrative that is rooted in fact, in the again the documents that were created as a part of the process, that will help an IRS examiner understand why our claim is so good.
That makes sense. I bet if you have the person who is very thoughtful in their process of experimentation, and they keep all their notes about every test, they keep all their prototype information, that one's probably easy to go back and put together the documentation, versus Dave, the maintenance guy, who is highly technically skilled on the machinery, and I bet everything exists in Dave's head, and he knows everything he did each step of the way, but it's not written down on paper. And so getting some of that information out of Dave's brain through an interview, I bet, is very valuable.
Definitely. Yeah. And I think that kind of thing absolutely will help support. We have to tie together the documentation with a narrative that makes it make sense as well. So getting those descriptions, I think, really help paint a much richer picture. And the kinds of things that we might end up looking at. Let's say that there weren't that no one did save the design revisions. Okay, that's fine. Are there emails talking about how many times we had to go back and forth?
Right.
Do we still have meetings in our Outlook calendars that have agendas talking about how we need to make changes, or how there was we're still having failures on that line that Dave was working on? A lot of times there are things like, project notes or test results or something like that. But if there aren't, is there even something from that time that indicates that it happened?
Yeah.
And those are the kinds of things that we tend to talk about, really just at the calculation level, not necessarily collecting them, but talking about what kinds of things does your company save? Do you know where they are? Do you know how long documents like that get retained? Is it a good idea to just put them all in a folder right now?
Let's talk about the value of the credit. And so how much can a business estimate that they will get in the value of the credit? And are there any different methods for calculating it?
So typically, we see the credit as being somewhere between 6 to 10 cents on the dollar for $1 of qualifying activity. So it can be tough to figure out the range of qualified activity in the first place. But if you have an idea about that, usually it's around 6 to 10 cents. Now,
Okay.
the credit is the credit for increasing research activities. So if your qualified expenses are increasing year over year, you might be on the higher side of that range. If your expenses are decreasing year over year, you're probably going to be towards the lower end of the range. You're right, there are two different calculation methods for the federal credit. We have the original method was the regular credit method, and then a second method we call alternative simplified was created after that in order to help additional companies kind of benefit. I can't get into the actual there's no good reason to get into how the calculations actually work. They are sort of complicated, and it's not really
not enough
helpful
time
to
here
talk
today for
about.
that.
But they both do, again, they both do consider a look back period.
Okay.
Again, so we're trying to evaluate the increase in research activities. But if your expenses are static year over year, you can still generate a credit. They don't need to be increasing. You'll just get a boost if they are.
How is the credit ultimately used? I know we spoke earlier about that some businesses can use it to offset payroll tax versus everyone can use it to offset income tax. But you want to go into a little more detail about how the credit is actually used?
I think there's really just one major point that I want to hit on this piece, because I think we did, pretty much talk through about, how you can use it to offset income tax or payroll tax. But the one key consideration here of can I use a credit? And this is particular, I guess, really mostly true for pass-through owners.
Okay.
If a credit is being passed through to a partner or a shareholder, that partner or shareholder can only use the credit to offset income associated with that activity or that entity. So if I'm a shareholder
that makes
and I'm
sense.
getting
If you're a shareholder in like multiple S corps, for example,
right.
you could only use this R&D credit to offset the income from that particular S corp flow through and not the other S corps that you're also a shareholder in.
Or I couldn't use my credit to offset income tax associated with my husband's W-2.
Yeah, that makes sense. I mean, it makes sense to us as, tax professionals. It might not make sense to, person on the street. That's why they have a tax preparer or a CPA to help them out with these things.
Right. So if you have an entity, if you're a shareholder or a partner in an entity that is performing qualified research, but only generates losses, then you might be eligible to claim a credit, but it might not do you any good.
That sounded a little bit complicated, which it is a great transition to our next topic, which is what are some of the other complicating factors that really need to be thought about or considered when you're looking at R&D credits?
I always talk about the R&D credit kind of being like if thens all the way down. And so we'll cover a few of them. And if we ever, if I ever talk to any of you about any particular situation, you'll probably hear me come up with a few more. One complicating factor is controlled groups. The definition of what taxpayers are considered a controlled group for R&D credit purposes is a much lower threshold than for most of the rest of the tax code. So if basically more than 50% shared ownership is going to make two entities considered to be a controlled group, even if they file separate returns. Okay. And that means that we have to compute the credit on a combined basis and then split the credit out to the member entities on a pro rata share based on the expenses they bring in. So understanding the ownership of different entities and what entities are part of that controlled group is crucial. If entities are coming in and out of the group, well then, we have like a lot of worms in that can there, because if you think I've got base years to worry about, it's not just about the credit year. So if an entity comes into the group, that means I need to update not only that credit year, I need to update my base year as well. So that comparison is apples to apples. So, if we got different tax years within a group, even more complicated. If we have short years, so short tax years, whether that's a credit year or whether it's a short year in the base year, that's going to require adjustments again so that our comparison of the increase is apples to apples. Even acquisitions or dispositions of a material portion of a trade or business. So not even a whole entity, but even just one plant or one business line is going to impact what expenses can be included in the base, et cetera. So there's a lot kind of going on there. I haven't even gotten into the question of internal use software and the high threshold of innovation tests that we need to evaluate for software development that is used internally at a company for general and administrative or back office functions. So it's just we can always talk about more.
Yeah. When is a business able, or when should they claim the tax credit?
The credit's usually it's claimed with your tax return. So,
okay.
Right now, as you and I talk today, it is 2026, and we're looking at the income tax return filings for 2025. So expenses incurred in 2025 would go into a 2025 credit to be filed with the 2025 tax return. So, when's your tax return due date? Is it coming up? If you want to claim a credit, are you going to have to extend, have time to do that? It's all sort of tied to the tax return dates. Now, there is some ability to claim credits on returns that have already been filed. So we can amend returns that are open to the statute of limitations.
Which is usually about 3 years from when the return was due, or if you filed late, you have a little more time. But I know from my experience, the IRS looks at the amended returns a lot of the time. So you might have a harder time initially getting your credit through on an amended return versus a timely filed tax return. Is that your experience too?
Well, it's definitely more difficult. So at this point, filing
takes a lot longer for sure.
Definitely. Filing an amended return claim for credit also requires additional documentation requirements to be submitted with that amended return and with the credit claim. In a lot of ways, it looks like the information that we're going to see required on that 6765, new 6765. So again, kind of first line audit almost. And IRS is allowed to review that and make requests of you or reject your claim just based on that. It's not an audit, so you don't necessarily have all the same protections you would have in an audit situation to make appeals and this and that. We also, just from a practical perspective, because the IRS is very constrained at this point, there are a lot of delays. So it's tough to know when to expect a taxpayer to be able to receive a refund, even if everything is absolutely picture perfect and the IRS has no problem with it at all, doesn't want to look at anything else, doesn't need any more information. We don't know when we can expect to see refund checks being issued. So it's, just processing times right now are long.
They're long. Everything is moving. Well, everything always moves slow at the IRS. They've lost a considerable amount of their staff in the last 12 months, probably 25% across the board in every department, and some departments more, some departments less. So there's fewer agents to do the audits. There's fewer people to do the processing of the returns. So I suppose, this increased documentation request or increased documentation requirement with the return is sort of, like you said, pre-auditing, so that way there's less of a need to do an examination at the back end. But man, everything moves so slow at the IRS. I always say it moves at a glacial pace unless they're trying to get you to pay. That's the only time they move quickly.
Yeah, and it doesn't mean that it's a bad thing to do. It just means that it's probably not a quick, quick cash infusion.
Yeah,
So probably not,
if you're gonna amend, you need to expect that it's going to take a while for the IRS to get to your amended return, and it's going to take quite a while to get a refund if it's what you're claiming.
That's what we're expecting. Yeah. Now there is some limited ability for some taxpayers to claim prior year credits. Without amending returns. So a taxpayer that has big net operating losses, NOLs, if a credit would not have made any impact on the taxpayer's taxable income or tax due, then we can simply add prior year credits as a carry forward update on a current year return. So kind of a specific situation in which that's acceptable, but it's a really nice benefit for those taxpayers to be able to claim prior year credits without having that additional administrative burden of amending returns, the additional administrative burden of that documentation, and can still get those credits claimed and on their returns.
Sort of wrap up here, what else should we know from sort of a recent legislative perspective on what's going on here with some changes to R&D?
This is a whole other webinar, I think. So maybe we'll get together for another one. We've talked about the research credit today, and everything we talked about is true, and in some ways it's really insufficient to talk about the kind of holistic perspective of research expenses for tax purposes, because we have been recently under a regime, the Tax Cuts and Jobs Act regime, that required capitalization and amortization of both domestic and foreign research expenses for the tax returns from tax year 2022 through 2024. That was a huge, huge change. We are now, we have the OB3 passed in 2025, summer 2025, that created a whole new Internal Revenue Code section that allows taxpayers to elect to return to immediate expensing of domestic research expenses. But foreign research expenses remain subject to capitalization with a very long amortization period, 15, 16-year amortization period. And the sort of administrative requirements of electing onto the Tax Cuts and Jobs Act regime and then off of it onto the OB3 regime are complicated. For taxpayers that were trying to ignore the requirement to capitalize and amortize under the Tax Cuts and Jobs Act rules, trying to wait that out and hopefully just be able to quietly return to immediate expensing, it doesn't look like that's really possible. So we're seeing a lot of kind of unwinding of these issues right now. We're seeing a lot of method changes being applied now. And there are affirmative elections required to return to immediate expensing under the OB3 rules. So even if you've been doing everything right, there are still additional reporting requirements to be made with 2025 returns in order to take advantage of this change back to these more taxpayer-friendly rules for domestic research expenses.
Well, this has been a really great information. Lydia, thank you for that overview of the R&D tax credit. I feel like every time you and I talk about R&D, I learn so much, and you really know what you're talking about here. Thank you, everyone, for watching today's SL Live webinar on unlocking R&D credits. Be sure to tune in for future SL Live webinars as we explore different tax, assurance, and other accounting topics. We're going to stick around for a few minutes of Q&A, so if you have questions, we will be happy to answer them. Otherwise, thank you, everyone.